and welcome to the Altos Trading live strategy session with Jeff Tompkins. This is your host, Richard Van Rich, and Craig Ward is not with us tonight. He's on vacation. Lucky dog. Hope you guys are too. Hope you're having a wonderful week and had a great Memorial Day weekend holiday. Really glad to have that. Really glad to be back in the markets here tonight. Got a lot of great information to go over. This is your first time on, you'll notice that your microphones are muted. That's how you can hear Jeff and I talk, but there is a Q&A box and chat box located at the bottom of your screen. So if you move your cursor around, you should see that located at the bottom. You can put any questions there, and we'll get to those throughout the session and also before we sign off. If you have to hop off for any reason, this is recorded and will be available in the members area later tonight and also on YouTube. So if you're watching on YouTube, please like and subscribe so you can get all of our future videos as we're posting those every week, because we are hosting these every Tuesday night at 7 p.m. And again, we're really glad to have you guys here with us. If you have any question about your account, anything, open trade alert, access to trade transillion, billing, any of that stuff, email support@altostrading.com, and one of our team members will get back to you sometime tomorrow. Before I bring on Jeff, let me just read the disclaimer. Altos Trading LLC and Trade Transillion software is intended to be used as an information service for subscribers, and it includes opinions as to buying, selling, and holding various stocks and other securities. However, the publishers of Altos Trading, Trade Transillion software are not brokers or investment advisors and do not provide investment advice or recommendations directly to any particular subscriber or in view of the particular circumstances of any particular person. Altos Trading LLC, including its owners, do not accept responsibilities for any decisions made by subscribers using the software and subscribers to the Trade Transillion software. Any person to buy, sell, or hold securities should do so with caution and consult with a broker or an investment advisor before doing so. All right, with that being said, let me bring on Jeff. Jeff, if you want to grab the microphone.
I'm all mic'd up, ready to go.
There you go. How's it going?
It's going well. Had a little time to unwind over the 3-day weekend, which is nice. And
good for you. What'd you guys do?
Well, I guess when I say unwind, I mean yard work. Did a lot of yard work this weekend. Some barbecuing, and of course, paying tribute to all of our veterans. Thanks to all the veterans out there.
Absolutely.
I have some of them on with us, so appreciate your service. It's the purpose of the weekend, of course. And yeah, how about you? What'd you guys do this weekend?
Yeah, we basically spent a lot of time outside. We got outdoors, did some hiking, did some backyard camping with my daughter, who really enjoyed herself. We did some s'mores and all that fun stuff. Fire pit, hung out with family. Did a little bit of yard work myself. Had to trim the hedges in front and back, lay out some lovely pine straw and all that fun stuff. But yeah,
it's the season.
Yeah, it is. It really is. But it luckily wasn't too hot, and I had basically a full cooler beer, so worked out well for me.
The official start of summer, as they say, right?
That's right.
Or the unofficial, I don't know. Unofficial.
Got my first sunburn going.
Yeah. I'm getting one of those next week.
That's right.
Going to Hawaii next week.
So that means next week we're going to be taking the week off, right?
Yeah, so we won't have our session next week, guys. Following week. So what is that? Week of the...
That would be probably the
12th. Yeah, so it'll be the 13th. Will be our next session. Yeah, so just FYI. Well, great. I hope you guys all had a great Memorial Day celebration. Some downtime to unwind, hopefully. And we're wrapping up the end of May, which is nuts. I mean, geez, we're almost halfway through 2023. Yeah, you can definitely all go to Hawaii with me. That would be awesome. Love to have...
Honey, pack your bags.
Right.
Go with Jeff.
Yeah, I'd love to have you guys. We do, by the way, do that. We have a VIP Inner Circle membership. We all get together once or twice a year in person. So you guys can check that out on our website. Something that we do. We like to see you guys face to face when possible. All right, so yeah, important things to cover tonight. Obviously, some critical key levels to watch as we approach the last trading day of the month tomorrow. Obviously, there's everything going on with the debt ceiling, which we'll talk a little bit about where things stand and how the markets are reacting. and then going into June. So now, of course, we're entering the summer months. There's that old adage, buy in May or sell in May, go away. So often, historically speaking, in terms of seasonality, we tend to see a run up in the markets first half of the year, and then a bit of a retreat and directional movements over the summer months. That's been proven wrong plenty of times. So I'm not a big fan of the adage, but it's probably more geared towards people who are buy and hold, or medium to longer term traders or investors. So there's still plenty of opportunity out there in the summer months. Volumes tend to thin out a little bit, and I think it's worth adjusting strategies, adapting to the seasonality of the market. So it's not something that should be ignored, but just not a big fan of the adage. But tonight we're going to talk about, after we map out our key levels, look at the VIX, see what volatility is telling us in relation to the indices. I'm going to talk a little bit more about moving averages, in particular the 36-month moving average. So moving averages are so commonly used among traders, retail traders, as well as institutional traders. The big difference I see between retail use of moving averages and institutional use of moving averages, so money managers, hedge fund managers, family offices, is the sort of the rationale behind the average. Typically with like technical traders, which makes up the bulk of retail traders, either learn about a moving average and see that it works historically on a chart, or just are taught or told that moving average is a good one to use. But the truth is, they really shouldn't be curve fitted or form fitted to a historical chart. There should be a rationale behind it, and that's why we use the 36-month moving average. So we can, number one, gauge market sentiment. When we look historically at a chart, yes, it provides good buying points in the indices. So the S&P, the NASDAQ, the Russell, when we get mean reversion into the 36-month moving average, that can be a good kind of value point to enter bullish positions in the indices. But it's not randomly selected. It's not selected based on what it looks like on a chart. There's an actual rationale behind the 36. It's not an arbitrary number. So it's not like people were going, looking at moving averages, starting at 1 and then going up incrementally, 2, 3, 4, 5, and they got to 36 and they're like, this looks great. That's not the case, but that's often how moving averages are treated. So tonight we want to shed a little bit of light on the rationale for moving averages. So if you use them in your trading, perhaps you've had success with it, but maybe you haven't, and maybe you wonder why do we use one moving average period over another? Do they work universally across timeframes? Are they universally applicable across asset classes? Those are all really important questions to ask yourself and consider when using a moving average. So we're going to kind of cover that tonight as we look at the 36-month moving average again, approaching the end of May. So I'll explain, why, what the rationale is, why you should consider that with any moving average you use, if you use them or considering using them, and why to be cautious if you learn about a lot of times people say like the 21 moving average is fantastic. It works on every time frame. It's a good indicator of dynamic support or resistance, all these things. Why is that? Is it just a self-fulfilling prophecy, or is there rationale behind it? And that's the distinction that we want to make tonight. So we're not going to talk a lot about it. We're not going to get deep into looking at all these different moving averages and things, but just to get the message across, and so we all understand why they can be valuable and the reason for that, versus just it being some arbitrary moving average that looks good on a historical chart. Okay, so it'll be kind of a brief overview, and then because we've ran out of time in past weekly sessions for our weekly roundtable, ticker roundtable, I committed to dedicating more time to that tonight. So get your tickers ready. We're gonna give you guys plenty of time to take a look at what you guys are watching in the markets. All right. So let's go over and map out key levels. Make sure we have our current data. That doesn't look like we've updated yet for today. One more refresh. All right, we're still waiting on our data update, which, by the way, for the zillion users out there, we are in the process of switching data brokers, and we're actually going to be going to a data broker that provides the real-time data. So you'll be able to get intraday charts on our Zillion platform. Very excited about that. So we have some testing to do still, but we'll keep you guys posted on the progress there. All right, so let's, and of course, we also have broker integration. So if you guys use TD Ameritrade, TradeStation, those are also available for integration. So you can place trades on Zillion and monitor open positions, access your account, and real-time charting. All right, so let me go over to our charts. And let's actually just start out with the monthly chart of the S&P, because this is so critical as we move into the end of May. Again, tomorrow is our last trading day of the month. And we've been watching closely the candle that that has obviously been playing out this month and rotated higher off of the 36-month moving average. All right, so again, we've seen a lot of historical dynamic support off of this 36-month moving average. So when we talk about moving averages and the period number, right? 36, 21, 7, whatever. If I put a moving average on my chart, like a 36 period moving average, it's going to adjust to the time frame that I'm in. So there's not, obviously a 36-month moving average per se. It's just a 36 period moving average. So when I apply it to a monthly chart, we call it a 36-month moving average. If I switch over to an hourly chart, it's going to be a 36-hour moving average. So moving averages are fractal in that they can be applied to any time frame. But when you switch the time frame, and here's a critical point: when you switch the time frame, the whole rationale and basis and significance of the moving average completely changes. So the 36 period moving average is a good example of that. So I apply the 36-month moving average or 36 period moving average to a monthly chart. I don't apply it to an intraday chart. And that's because of the rationale behind it. So again, it's not arbitrarily selected. It's selected based on secular bear and bull market, kind of the cyclical and secular nature of bear and bull markets. So the reason it's used is because there are we obviously went into a bear market last year, and there's a cyclicality to the lengths of these types of markets. So they tend to last for a certain period of time, regardless of the catalyst, regardless of the economy and such. So when we apply it to a monthly chart, the rationale behind it is based on the cyclicality of bear and bull market duration. So it wouldn't have much, obviously, a significance in that respect on an intraday chart. Now, we don't want to discount the historical significance of a moving average, but the tendency is when the smaller the time frame you go down to, there's really not much fundamental significance to the average. You get down into like minute or even hourly charts, there's not going to be a lot of fundamental significance behind that. But when you're looking at daily, weekly, monthly charts, then yes, you're going to see less technical, more fundamental rationale behind the average. So 36 months obviously corresponds to 3 years. And when we see, as we were just in the last decade, a little bit more than a decade, we were in a secular bull market, right? So when we escape out of a secular bull market that's lasted a decade, historically, and there are also other fundamental reasons to extrapolate to future expectations, we tend to see like a 2 to 3 year bear market. So bear market doesn't necessarily mean that we're losing 20% peak to trough every year for the next 2 or 3 years. But it does mean that we may not expect to see the markets come back up to previous secular bull market highs. So that's what you see here in the month of January of last year, 2022, where we hit the all-time high in the S&P. Okay, so we may not get back up there for 2 to 3 years. But in the interim, we mean revert, right? We sell off into an average that is, and moving averages are based on historical price data, right? All it is an average price over a number of periods. So we're just averaging price over 36 periods. And that's the rationale behind it. It's due to the cyclical and secular nature of bull and bear markets. And that's why I use it exclusively for a monthly chart on the major indices. Okay, so looking at this monthly chart of the S&P, we can see in past mean reversions, and I think we're only looking back 10 years here. Let's go back further. Let's go back 20 years. Right, we see in bull market conditions, we tend to spend more time above the moving average. And then we have, market sell-offs, market crashes. Here's the market crash from early 2020 due to COVID, bear markets, all these different catalysts, black swan events that cause mean reversion. And then, so historically, this was a bad one. So this was the 2008 mortgage crisis, right? Which over the last 20 years is the most time we've spent below the 36 period moving average. So historically speaking, other than 2020, where we did spend a significant amount of time below, but nevertheless, we tend not to see in the broader indices a huge, price movement below this average. This was definitely an extreme case, but still not too far off the average in relation to how far away it can move from the average to the upside. So, so again, due to the cyclicality of the broader markets, the major indices, this can be a reliable dynamic support level for buying opportunities, right? So whether you're a trader, a short-term trader, a swing trader, a long-term investor, this offers a lot of insight and value. And we've talked in past weekly sessions like the different ways to analyze and trade these, but focusing back in on May, we saw a sell-off into roughly a half-century mark on the S&P around the 40-50 level, and then buyers coming in and driving prices higher. So we have one trading day left. So it's very likely we're going to have a bullish close for the month. It's in the context of a rotation off this average. And we are in close proximity to a really critical resistance level. And so the close tomorrow is going to, I think, tell us a lot about the coming months and even the rest of 2023. And that's 4,200. So notice, of course, today we closed just a little over 5 points above. So I'm looking, and the value of looking at this monthly chart is it allows us to see very easily the highs and lows of the month. So there's a very significant obvious high from February here at 41.95.44, so just below that 4,200 level. And today's close above that, but if we can close the month above this, that's step number one to higher prices in the broader markets, in the major indices. Step number two, to really clear this this significant resistance at 4,200, is to trade above, get a strong move above the month's high. So right now that resides at 42.31.10. Right. So if we can push through that in June, and because summer months tend to be softer and we don't tend to get as much directional movement, if that happens in June, July, August, September, those are really the two things that I'm looking for to get more aggressive with bullish trades, bullish investments, and consider this 36 period moving average to hold more medium to long term, because it's held in the midst of this bear market, in the midst of extremely high inflation levels we haven't seen in 4 decades, higher interest rates, all of the things that are weighing on the economy. On a technical basis, the S&P has held that pretty well. So yeah, there's other things that could come up, but that's what I'm watching right now. And that's the rationale behind the 36 period moving average. So again, when we get into intraday timeframes, there's probably not going to be much fundamental rationale behind a moving average. It's probably going to be more technical, like, all right, this seems to, it's a self-fulfilling prophecy. Seems to be traders that are paying attention to this, and it's serving as a reliable support or resistance level. But when we consider using a moving average, rather than arbitrarily selecting one or learning about one and having other people tell you that it works, think about the reason why we're using it, because it is still using lagging price data, and that can be good or bad. Most of the time it's bad, but it can be good if we use it in a way that makes sense, whether it's seasonality, cyclicality, reasons that relate to how the markets actually move, then I think it makes sense. And so again, that's why we focus so much on this every week. But again, let's go over to the daily chart, map out the key levels, but this is looking positive. Caveat, don't get faked out by it. We're still on the close today, very close to 4,200 key resistance. So this is not something we want to get tricked by. I really want to see, let me pull up my pen here. Okay, I want to see in June, price come above May's highs, and not just slightly, because that could be a false break of May highs. I want to see it, it could trap traders and we could get a bearish reversal in June. I want to see strong price action to the upside above May highs. We still have highs from last year to contend with around 4,300. So also, don't get tricked if we start to get movement up there and then hit 4,300 and get a reversal. So any bullish positions I put on above May highs are going to be very closely monitored and potentially exited around 4,300 or scaled out with risk reduction by stop loss management and so on. With the expectation there's a good likelihood of reversal around 4,300. We get through 4,300 this year, and we get particularly a monthly close above 4,300, then I'm going to get more aggressive with bullish positions. Okay, so there's a few things that still have to happen here. So let's get back over to our daily chart. Hopefully our data is updated here. No, still not. Okay, let's switch over on this chart. All right, so 4,200. All right, and see how today, after the 3-day weekend, we gapped way up. Still had a bearish close on the open, but not really much off the close from Friday, and found support right at that 4,200 level. So watch for that to hold the rest of this weekend, and in particular tomorrow. So the debt ceiling. And as we get over into the NASDAQ here in just a second, there's a pretty decent disparity between NASDAQ, Dow, and S&P sentiment and price action right now. NASDAQ's largely being driven by all this excitement behind AI. NVIDIA just hit this $1 trillion market cap. So that's what's pushing the NASDAQ higher. It's ignoring the debt ceiling. S&P and Dow are not ignoring the debt ceiling so much. Hence, we're seeing this, hesitation to really push higher like the NASDAQ is. So what happened over the weekend? Biden and the House Speaker, Kevin McCarthy, basically said, we've reached this deal. We're going to cap the baseline spending level for the Fed. I think they said for like a period of 2 years. And then they're going to, of course, like they always do, raise the debt ceiling, right? Kick the can down the road. So they haven't actually, finalized all this, but that was the comment. And so that, kept markets afloat to a degree. It obviously resulted in a big move up in the futures over the weekend, but then there was uncertainty in trading today that caused, a rotation lower off the open. So that's kind of what's happening. The House votes Wednesday night, so tomorrow night. And this should kind of all shake out this week. All right. So they're confident that, they're going to get the bill through, and then they're going to make the vote tomorrow night. So likely tomorrow, we're not going to see a whole lot of movement. So I don't want to make any big you know, commitments tomorrow in my trading, I'm going to be cautious. I'm going to be patient, wait for the dust to settle, see what happens. Days like tomorrow are where a lot of traders kind of get trapped and tricked, and you know, it's basically uncertainty. And there's not really much else out there right now that's going to drive markets in a very short period, unless there's some sort of black swan event. So watch out for that tomorrow, because 4,200 is critical this week, tomorrow, this week. And then as we looked at on the monthly chart, 4,300, that's going to be more medium to long term to the upside. All right. Zoom in a little here. All right, so watch, and because we had you know, this high at the quarter century mark, 43.25 back in middle of last year, watch that too. Obviously, big sell-off from that level. So there's this kind of resistance zone to watch if we do move higher up into the 43 to 43.25 level. And then if we can get through that, you know, we'll be having new conversations in subsequent weeks on our sessions. All right, so those are the really critical things to watch. And just to emphasize on the moving average, so this is still the 36 period moving average, but now we're on a daily chart, right? And so you can see that it doesn't look the same, right? You don't see this on the monthly chart where we're, you know, having more significant and frequent movement below the average, right? And when you look at the average, it's like waves in an ocean, right? It's just not directional. We quickly switch back over to the monthly. So we see all the waves, right? It's very steady. So when we you know, use moving averages, consider the time frame, consider the rationale behind the average. Does it have one? Is it purely technical? Is it fundamental? Is it a combination? And then I think the key takeaway that before we get into ticker roundtable, and then of course we'll look at the NASDAQ and VIX before we do that, is look at the smoothness of the average. Okay, if it was like what we just saw on the daily chart and it's up and down, right? So if you're getting like on your average, it's going to be very difficult to use. Okay, if it's very smooth, it's an observation on a chart, but there's a rationale behind it. There's a reason why this moving average is smooth. There's a lot of reasons, not just one. Okay, but key takeaway is that's a valuable moving average to use. So that's I think, you know, if you either ignore or maybe just aren't privy to the rationale behind the significance of a moving average period, that's fine. The way to you know, identify if there likely is good rationale behind using it is how smooth the average is. So if you're using one that's very choppy, it's probably useless and difficult to use in live trading. If you're using one like this that's very smooth, then there may be a greater likelihood of good rationale to use that in your trading. And of course, it'll be much easier to use. Again, if you look at a 15, 20, 30, I mean, we can go back 5, 6, 7 decades, look at the 36 period moving average on a monthly chart. If you just bought the S&P 500 every time it reverted into the 36 period moving average, all right, it's still to be determined here, obviously. Okay, it would return, your return on investment would be very, very good, right? It would return not just consistently and accurately, but percentage based, it would give you a good return over time. Okay, it takes a long time to play out on a monthly chart, but that's the point. All right, so let's take a look at let's go back over to the daily. Take a look at the NASDAQ 100, which of course, as I mentioned, has been on a tear due to NVIDIA, all this enthusiasm around AI. So we've moved away from the mean. We've diverged from the mean probably on all moving average periods, because it's been basically a parabolic move. We had a little bit of a pullback around the third week of May here, but we've moved up a lot. So this is a period of 1 year on the daily chart. I'm going to actually go out to 2 years because we're now above significant prior resistance. Let's actually go out 3 years. All right, so where might we run into resistance? Well, half century 14,500 happened today. All right, so looking back here on October of 2021, we have key support broken 2022, retested, broken again, brief period of support, broken, consolidation, retested, and then bear market. Okay, so now we're back up to 14,500 on the NASDAQ. This is going to be a difficult level to get through, considering that we just had this major run up into the level off of around 11,500. All right, so we're at very significant resistance on the NASDAQ right now. And the catalyst that put us up there, which was largely, again, what I just talked about with AI and NVIDIA, has probably run its course. So all that exuberance is probably played out. So this is a risky area to the long side on tech right now. There's, with the rejection of 14,500, that's on the NDX. We'll look at the Qs as well, but and then the bearish price action from today, a risky level to the downside. All right, so that's on the NDX. Looking at the Qs, okay, it's going to look very similar, just different prices. That's going to be right around 350 on the QQQ. Let's see how that corresponds there. So currently a resistance level. If we get strong closes above it, watch for false breakouts. If we start to rotate higher, considering that we break through 350, 370 on the Qs is going to be a key resistance level. If this 350 level holds and we continue to move lower, 335, 320. Also going to right around 345 are going to be our support levels. Okay. Now, what is the VIX doing? Okay, so we've had a couple VIX spikes that were correlated to retracements in the S&P, downside retracements. So we've been spiking up to kind of right around the 21 level. We're not getting any real significant closes above 20, which is our critical level on the VIX. And we're spending a lot of time below 20 this year, which is bullish for the market. Okay, but it's also, as we hit those resistance levels that we just looked at on the NASDAQ in particular, but we're also right around one on the S&P, albeit we're above it now on today's close. A situation to be cautious, right? So when VIX is low and markets are hitting highs that they haven't seen in quite some time near these key levels, this is where I get cautious. So I put on smaller positions, if at all. I wait for confirmation of directional movement. So if I put on a bullish position, I want to, get confirmation those levels will hold and markets are rotating higher off those support levels, and VIX is staying below 20. If I want to put on bearish positions and capitalize on the downside movement, I want to see VIX spiking above resistance. And again, this is our resistance on VIX. So I want to see it above this resistance zone of 20 to 21. Just like we saw back here in March. And I want to see S&P and NASDAQ rotate lower off those resistance levels. And in the case of the S&P, it would be breaking back through what's now support and was just recently resistance. All right, so that's how I'm looking at the VIX right now in correlation to S&P and NASDAQ. And then lastly, and then I'll open, pause for questions. I always watch our trade trend signals on the VIX. Okay. They don't necessarily tell us the magnitude of a spike, but they reliably tell us when VIX is below 20 that there's a likely spike in the VIX. And the way to gauge the magnitude is to know what's happening in the S&P and the NASDAQ. What are the key levels? What are the areas of support and resistance that we may encounter? And what are the catalysts that could cause a dramatic move in the broader markets? Okay, so just on a pure technical I guess what would be the word for it? Algorithmic basis, this is a reliable indicator, ahead of time before a retracement or a sell-off or a correction of that occurring. And these are the buy signals from our algorithm, okay, which give us 2 to 3 days of advance notice before these spikes. And these are significant spikes on a percentage basis because VIX was down at 16, spiking up into 20 or 21. So we're looking at very high percentage spikes on the VIX, which correspond to down moves in the indices like the S&P. So we've had a few of those, but now we're back down. So there's currently no signal. Okay, so we're neutral on VIX buy signals right now. But if we get any more than the 3 we've had over the last couple months, I start putting, hedging long positions, putting on more bearish positions if we can get above 20. Okay, so watch that 20 level. All right, so that was a bit of an extended market analysis, but I think critical moving into the end of May and getting close to the second half of the trading year. So I wanted to spend more time on it. Also, of course, distinguishing the importance of different moving average periods and considerations to take into account if you're using them in your trading and why you're using them and why they might be valuable and why they might not be valuable, and how to determine that, whether it's a fundamental rationale or it's purely visual and you're looking at a smooth moving average versus a very wavy and choppy moving average. So hopefully that gives you guys some value in your decision making, your analysis. So again, a bit long. I apologize, but hopefully you got a lot out of it. So I'll open it up to questions, see if you guys have any questions or comments, and then we'll open it up to ticker roundtable.
Chris asked, do you just use like one moving average? Do you adjust it down, let's say if you're doing daily or weekly, or you just typically use the 36?
No, so I use different moving averages for different periods. So that would be time frames. So like, as I said, like I don't use a 36 period moving average on any other time frame than a monthly chart, and that's because of the rationale behind using it on the monthly chart. You know, on a daily chart, my rationale for using a move, you know, particular period would be probably one other thing I didn't mention too. The asset class matters. You know, so whether I'm using it on an index like the S&P or an individual stock. So if I'm using it, let's say on an individual stock, I would be more apt to look at like seasonality. Is there a seasonality behind, you know, that particular stock based on the industry, the sector, the business model, whatever it might be? And is it, you know, is it correlated to what I'm trading? If it's not correlated and it's just a randomly selected, and you know, unfortunately, we're vulnerable to that because a lot of marketers out there, you know, it's an easy marketing tool. Like, oh, okay, there's this magical moving average that works with everything. Well, it's not the way it works. Like it's, you know, there needs to be a lot of thought and consideration into it. So I really very carefully adapt. If I'm going to use a moving average, adapt it to the time frame, the asset class, the actual, you know, asset, you know, be it a stock or a forex pair, and then I, you know, also price action. So even if, you know, you're not looking at all those, like if you're purely a technical trader, then the best thing you could do, but you should still do it if you're taking those other things into consideration, is look at the smoothness of the moving average. If it's all over the place, like we looked at the 36 period moving average on the daily chart, then that's a good indicator it's not reliable and going to do what you want it to do. It's going to be difficult to trade. If it's very smooth directionally and there's not a lot of like huge waves in it, then it might work for you, right? So you got to look at the volatility of the asset, seasonality, cyclicality, all of those things. So yeah, I use different ones for different timeframes, asset classes, stocks, all of those.
Right. Well, let's see. Got a lot of tickers kind of come in. Let's see here. I'm gonna go ahead and pick one, or
Yeah, I want to get back over to Zillion real quick and make sure, see if we can get our data for today.
might be running a little slow because they added a bunch of tickers today.
Oh, that's right. Yeah, we did a big update today in the system. That's probably what's causing it. We might be able to get it on individual stocks. Sometimes the indices take longer. Yeah, let's go ahead and take some.
All right, let's see. Delaney asked to see S is in Sam, M is in Mary, C is in Charlie, I is in Iris, SMCI.
Super micro. Yeah, a lot of these stocks, you know, these microchip processors and whatnot are getting buoyed by the NVIDIA. So let's see, is this still May 26th? Just have to stick with. Yeah, all right, we'll just stick on their other charts. All right, so that was SMCI. I'm going to take the moving average off here. All right, so SMCI, so that's, you know, likely the catalyst. I'm not real familiar with the name, but likely the catalyst behind this parabolic up move. There's been some really great buy signal opportunities. The one that came in yesterday, although we had a big move up, probably somewhere around, because we closed up from the open 6.8%, so probably somewhere around 13% move intraday on the high off this one buy signal. This was one where I'd be very cautious on any further directional movement, because we're at least 1 year all-time highs, possibly more if we go. Actually, no, we're looking at 3 years. 3 years. By the way, I'm gonna zoom down. So we're at least a 3 year all-time high. So high risk of some degree of a retracement. Again, I think a lot of this exuberance around the chip sector, all this AI stuff is probably likely played out. So this is a good time to take profits on anything that any long positions, I think, just in my opinion. Obviously not telling you guys what to do, but yeah, this one's hitting new all-time highs over at least the past 3 years. I think it's just when you're in that situation, there's just, after a parabolic up move, a higher risk of a retracement. But on this particular signal, our stops all the way down at 157 roughly, which is a huge percentage from entry, and due to the fact that volatility and average true range are very high right now. So it was a great opportunity on some of these previous signals, but and even from yesterday's, or I should say Friday, markets were closed yesterday, Friday's signal, the last trading day signal provided a good opportunity for today, but not very much conviction on this close today. So you can see that from the high at 242.99, close at 234.10, quite a bit, off of that high. So one where if I was trading it, would be to the long side, would be cautious.
Okay, pretty cool. Let's see. Eric wants to see AXON.
Okay. All right, so Axon Enterprise. There's some levels here that I would be watching right around 210, kind of more of a zone. There's very strong resistance up here around 230. Kind of redraw that closer to the 230 mark. So what I notice here is, when we broke out to the upside, entered this roughly 20-point range back in February. So February, March, April, obeying the range, and then broken in the beginning of May. So this prior support, right, is now transitioned to resistance. This is very strong confirmed resistances over the past few weeks. We've traded below it. We had a sell signal here just below resistance. A lot of volatility in this stock. So that sell signal is taken out on the trailing. So currently not an open signal, but the key thing I would watch on this stock is it's below this significant resistance at 210. However, still residing within the range of this very bearish candle, which was around the earnings announcement. So there was earnings here. So I always, when we have price action like this in a brief period of time, like in this case, 1 day based on earnings, and price is just bouncing around within the high and the low of that particular period, to me, that's non-tradable. Like I want to wait for it to get out of this range where there were, obviously buyers and sellers, right? And so there are obviously many more sellers on the day earnings were released, but since then, we haven't broken this range. So that's what I would wait for here is, are we going to break it? But it's looking like technically most likely we're going to break to the downside because of the resistance level here around 210 in this range that was broken on the earnings announcement.
All right. Richard has to see MNST.
Monster?
Yep.
Right. Right. So currently no signals on Monster. Surprised one didn't come in down here, but let's look at this range. So around the 5250 to 53 area and roughly the 50 level was a medium-term range. Right. So broken in March, retested, and then parabolic move. Okay, so again, I don't see a lot of like near-term trading opportunity in Monster. But in terms of like weighting bullish to bearishness, we had a little retracement after this parabolic move and another run up into this 52-week high around 60.50, and then a pretty big sell-off from there. So because we broke this 58 level from the low here and then retested it over the last few trading days, I'm seeing this as a resistance. And most likely is a retracement in this this leg down here. So this is a down leg. Okay. And speaking in terms of probabilities, likely has a greater probability of moving down off resistance. But 58 would be the critical level I'd be watching this week, starting as early as tomorrow, because it was encountered today. Today's high was just a little below 57.89. So if we can get a close back above, but that's the level I would watch, 58, to see whether we can push higher through 58 or whether it holds as resistance, indicating a greater likelihood of another leg lower.
Awesome. Let's see. Cy wants to see AVGO.
Have go Broadcom. Oh yeah, yeah. This one I'm going to go out a little further. Let's go even further. It's like an all-time high. Could be. I'm going back 10 years. So interesting. Let's zoom back in here. So going back, a decade, there's no technical resistance, but very bearish candle, obviously, today. And it's, always look at daily price action in the context of the aggregate, right? What led up to it? Well, again, parabolic up move. There hasn't been really any retracement. We had 4 days of sideways price action here in around the third week of May, but again, the buy signal from Friday would have been awesome. If you had your entry above Friday's candle, and took profits intraday. But from a, swing trading perspective, not loving it. The move's already really happened. So in this is often what we see. Kind of a good lesson here too. This is a good, with Broadcom, a good demonstration of trading range breakouts. So this, range started, there was a prior range before that, but in February, and persisted for months until around, mid-May, third week of May, had a breakout. So these can be good trading opportunities. They don't come along often. And there's also, a degree of risk in terms of a false breakout, but I think the degree of risk for a false breakout is lower the longer the range persists. And then you get, if you actually look at and analyze the price action of the breakout. So in this case, there were 2 days of very strong closes. So looking at average true range, close, proximity of close to intraday high, all of these things, that was a good indication back in May, earlier in May, that this thing had some legs. But I think that's kind of played out. And obviously, I don't know what happened today with Broadcom and what was the cause of this crazy range from like 800 to 920. That's insane. But especially if you look at the range relative to the average prior, daily candle ranges. So the lesson here is and we've emphasized this, almost every week in our weekly sessions: volatility, contraction, and expansion. So if you're ever wondering, like, all right, a move is taking place or it's already taken place, is it too late to get in? The way that I answer that is, markets always contract and expand, in that order. Okay, so here we had volatility contraction in different aspects. We had the range, but also looking at the range of the individual candles, relatively small. As breakouts occur, we get volatility expansion. If there's any kind of a stall or, pause in the breakout, we get a little bit of contraction. Okay, so it always happens in that order. So here we have volatility contraction, we have volatility expansion, then we get some volatility contraction followed by volatility expansion. So the easiest way to identify that is look at the high and low. If they're getting wider and wider, and over the last 3 trading days, that's been the case, that's when you should be in the trade, right? But it's also when I'm in a trade and I'm seeing volatility expansion, I know with certainty that volatility contraction is coming. So I'm going to start getting lower or tighter high-low ranges, which often after a move up in the security corresponds to stalling price, sideways price action, or lower prices. So we don't want to get caught in the trap of like timing. Maybe tomorrow is going to be more volatility expansion, maybe day after tomorrow, but it's near. We're going to get volatility contraction. If you look at the expansion that's taken place here, it's on the horizon. So that's what I'd be looking for here. But I would say, other than Friday's signal, no current real opportunities in Broadcom.
All right, let's see. Can we do one more?
Yeah, let's do one more.
Todd's got SMCI.
Okay, another micro chip processor stock, super microcomputer. Yeah, it's the same thing. Here the good opportunity was to get in on the range breakouts. So stock was in this range here, 120. So buy signal back here at the start of May, volatility expansion. So this is kind of what we were just talking about. So we had volatility contraction, we had a range in place and relatively tight individual high-low candles. And then we have volatility expansion happens here, triggers the buy signal. And this was a reliable breakout. So again, that's a good way to identify, like if you've ever had challenges with breakouts, watch for the volatility contraction expansion. So if you see a breakout where you don't get good volatility expansion like this out of a range, then it's more likely to be a false breakout. So that's a good indicator. It's not 100% reliable, but it's a good indicator to help put the odds in your favor. But this is a good volatility expansion breakout, which again is always at some point followed by contraction. So here's the volatility contraction. Okay, so what's happening here is traders are like, okay, this thing just broke out of the range. Obviously, it attracted a lot of buying interest. In this case, around an earnings release. But let's pause here for a second, see how the market reacts to this. Are people gonna start taking profits and drive the share price back down into the 120 level or below, which is now was our resistance, is now support, or is it going to stall out and continue to take off? Okay, so that's what's happening here in volatility contraction. There's not a lot of shares being traded. People are kind of holding on, waiting to see what happens. And once again, just like this range, the longer this happens, the more likely is it's going to resume the prior breakout. If this had reversed back down, it would have likely happened rather quickly within a few candles or a few days in this case. But it just stalled out and it just took this day around mid-May to resume it. Okay, so another volatility expansion. See how the range of this candle is much wider than the the indecision period, the volatility contraction period. All right, and then we had another little one here, and then boom. Okay, but now we're in volatility expansion. Okay, and this is actually a better case than Broadcom. So I'm just visualizing this without actually looking at the true highs and lows from Friday and Thursday. It looks to me like we had some volatility contraction today. It looks like the high and low range is less than last Friday and Thursday, which is something that I'm always watching for if I'm in a directional trade. So if I were in a long trade here, if I see volatility contraction, tighter high-low range from previous days, it's a very good indicator of a stalling of the directional trend and higher risk of reversal in the opposite direction. Okay, so again, just one piece of the puzzle. We also need to be looking at the bigger picture. Going back 10 years on SMCI, this is an all-time high. Okay, also high risk to the long side because the move already took place. So this thing's not going to, probably not going to go up to 500 or 1,000. So myself being a contrarian trader and investor, these are periods where I would look for short opportunities, but I need the confirmation. I don't want to. I don't know what's the opposite of catching a falling knife. You don't want to try to pick the top, but this is looking very toppy. And same thing, to the downside. Catching a falling knife is always a dangerous game. Like the best way to catch a falling knife is wait for it to hit the floor and then pick it up, right? So that's works just that way to the upside. We wait for the confirmation. We can't pick a top or a bottom. So this is high risk to the long side, but no confirmation yet to the downside. But all good ones to look at. A lot of them are chip related, may have some correlation to AI and NVIDIA to the market that's really being propelled by all of that. So great ones to look at.
All right. So
All right.
I got.
Cool. Well, thanks for sharing those, guys. Those are great ones to look at for tonight. Any final questions before we wrap up?
No, I think we're good.
All right. Well, I hope you guys have a great rest of the week. So just quick wrap up. Again, obviously watch what happens with the debt ceiling tomorrow, but watch it in the context of those levels that we just looked at. And we'll make sure to get the recording from tonight uploaded by tomorrow, so you guys have that to review. If you didn't notate those levels, because they're going to be critical going into June as we start up a June trading month this week. So we'll make sure to get that up, but watch those in the context of what happens with the debt ceiling, watch how the market reacts, and then watch what the VIX does in relation. Remember inverse correlation. The VIX often tells us ahead of time what the S&P, the NASDAQ, the rest of other major indices are going to do. So always look at, the aggregate, look at things in the big picture, and hopefully that will help you guys navigate this moving into the summer months. So any final words, Richard? Oh, we did have one. Yeah, we had one thing. Did you want to, Richard, mention the?
You go ahead.
Okay, well, you'll have to put the link. Do you have the link ready for the
Let me see.
surveys?
Yeah, let me see.
So guys, we're doing, if you're interested, we're doing like brief interviews with our most valued members, which of course are you guys. You join us every week and take part in our live sessions. So we're doing like customer satisfaction interviews just to gauge what has been working for you, what you like, what you might not like, what you want to see improved, maybe suggestions for things that we're not doing. They're just brief, 15, 20-minute sessions, but it's with me. So we do them one-on-one together over a Zoom. And for your time, we compensate you with a $50 Amazon gift card, just as a thank you for giving us your feedback and taking your time to meet with me. There's no obligation or cost on your part. It's purely just something to help us out and help our other members out, in terms of making decisions for joining a service or, those types of things. So Richard will put a link in, or did you? Yeah, you already, Richard put the link into chat. If you guys are interested in being a part of that, we have a lot of different days and times available for you to select: weekdays, weekends, evening times, and things. So if you're interested, you can go ahead and click the link, and we'd love to hear more from you. And again, we'll offer you a $50 Amazon gift card if we select you to do an interview. So upon completion of your interview, we send that to you by email, just as a thank you. So just wanted to throw that out there too. Again, I'm going to be gone next week, so we won't have our weekly session next Tuesday. We'll resume that following Tuesday on the 13th. And that will also be the week that we resume our interviews. So we wouldn't be holding one next week. Anything else, Richard, I missed?
No, that's it. I think you covered it.
All right. All right, guys. Well, thanks so much. Have a great rest of the week, and we'll see you week after next.